Hey there. So, you're thinking about investing, but maybe it all seems a little overwhelming. If you're not sure where to even begin, don't worry. You are in exactly the right place. Today, we're going to lay out a clear roadmap and turn all those complex market ideas into a simple, step-by-step journey.
So, here's our game plan for today. First up, we're going to tackle the single biggest decision you have to make, your core strategy. Then we'll get you the right tools for the job. After that, we'll show you how to build a portfolio that can actually weather a storm. And then we'll dive into the psychology that trips up so many investors. And finally, we'll get down to the brass tacks and figure out where your money should actually live and grow. Ready? Let's get into it. All right, let's dive right in. First stop on our journey. This is the big one. This is probably the single most important decision you're going to make as an investor. If you get this right, pretty much everything else just falls into place. It really defines your whole relationship with the market. So let me ask you a question that gets right to the heart of it. Do you want to try and outsmart the market? Pick the winners and beat the average? Or do you just want to become the market and ride its wave of overall growth? Your answer to that simple question is your first big step.
This choice really boils down to two very different philosophies. Think of active investing like being the captain of a sailboat. You're constantly adjusting the sails, you're reading the winds, and you're trying to outmaneuver everybody else to win the race. Passive investing? That's more like booking a ticket on a massive, steady cruise ship. The goal isn't to be the fastest ship in the sea, but just to reliably move with the tide and get to your destination.
And this table kind of breaks down how those two ideas play out in the real world. With active funds, you're paying a manager to handpick investments, hoping they can beat the market. And that's why those fees are higher. With passive funds, the whole approach is way simpler. They just buy everything in a market index, like the S&P 500. The goal isn't to beat the market, it's to be the market. And look at that last row, the fees. That difference is a huge deal.
Okay, so you've picked your philosophy, active or passive. Awesome. Now you need the actual tools to put that strategy to work. So let's open up the investing toolkit and see what you'll be driving.
For most of us, the main tools we're going to use aren't individual stocks, but funds. Just think of a fund as a basket that holds a whole bunch of different investments, like stocks and bonds, all bundled together. It's a super efficient way to own a little piece of a lot of different companies all at once.
And in the world of funds, you'll mainly run into two types, ETFs and mutual funds. The biggest practical difference is how they trade. ETFs, or exchange-traded funds, are a lot like stocks. You can buy and sell them all day long, and their price is constantly changing. Mutual funds are different. They're only priced once, right at the end of the trading day. And because of that difference, ETFs are usually the go-to for passive strategies, while mutual funds have traditionally been the home of active managers.
So, does all this really matter? A 0.5% difference in fees sounds tiny, right? Well, the impact is actually huge. That small difference, just 0.48%, can be one of the biggest factors in how much money you end up with. We're talking about a difference that, over 30 years, could mean tens of thousands of dollars more in your pocket. It's a massive hidden cost, and it's why this stuff is so important to understand.
Okay, we've got a strategy and we've got our tools. Now let's talk about the blueprint for your portfolio, diversification. This is how you build something strong, something that can stand up to the market's inevitable storms.
I absolutely love this quote from Fidelity, because it gets right to the point. Diversification isn't really about trying to hit home runs and get massive returns. It's a risk management strategy. The real goal is to smooth out the ride, to make sure your entire portfolio doesn't sink or swim based on just one single investment.
You've all heard the saying, right? Don't put all your eggs in one basket. That is exactly what this is. The whole idea is that different parts of the economy do well at different times. So by owning a mix of things, stocks for growth, bonds for stability, you build a portfolio where, hopefully, something is always working in your favor. It just smooths out the bumps along the way.
And hey, don't just take my word for it. Look at this. This is a real-world stress test, the 2008 financial crisis. As you can see, the all-stock portfolio, it got hammered. Cash was safe, sure, but it didn't earn you anything. But look right there in the middle, the diversified portfolio. Yeah, it still went down, but it acted like a giant shock absorber, cushioning the fall and putting investors in a way better position to recover. Now let's move on, because this is where it gets really interesting. Having the right strategy and the right tools is only half the battle. The other half, well, it's all in your head. The biggest obstacle to your long-term success is very often the person staring back at you in the mirror.
So the first major bias we all have to fight is something called loss aversion. It's wild.
Psychologists have actually found that the pain of losing, say, $100 feels about twice as bad as the pleasure you get from gaining that same $100. Our brains are literally hardwired to avoid pain, even if it means making any irrational choice.
And this has real-world consequences. This is what causes people to panic and sell at the absolute bottom of a market crash, locking in their losses forever. It also makes us do the opposite. Hold on to a losing stock for way too long, just hoping it'll come back, even when it's clearly a bad idea. It is a powerful and often destructive force.
The second bias is recency bias. This is our brain's funny little habit of thinking that whatever's happening right now is just going to keep happening forever. So when the market is soaring, we think it'll never stop. And when it's crashing, we feel like it's never going to recover. We totally forget to look at the big picture.
A perfect and pretty painful example of this in action was the dot-com bubble. Back in the late 90s, tech stocks seemed like they could only go up, so investors just poured money in, convinced that what happened yesterday was a guarantee for tomorrow. We all know how that story ended. That's recency bias for you.
So how do you protect yourself from yourself? Well, it really comes down to these 4 things. First, have a plan and write it down. This is your anchor when loss aversion kicks in and you feel like panicking. Second, stay diversified. This keeps you from getting caught up in the hype of one hot sector. Third, maintain perspective. Zoom out and look at decades of market history, not just the last 5 minutes of headlines. And finally, control what you can control. You can't control the market, but you can always control your costs.
We've covered strategy, tools, portfolio design, and psychology. Now for the final practical step, choosing the right house for your investments to live in.
Okay, let's break down 2 of the most popular homes for your investments, the Roth IRA and a standard brokerage account. The biggest difference is right there in that top row, the goal. A Roth IRA is designed specifically for retirement, and because of that, it comes with a superpower. Your money grows and can be withdrawn completely tax-free. The catch is that there are rules. A brokerage account, on the other hand, is all about flexibility. No limits, no rules. You can use it for any goal you want, but you will have to pay taxes on your investment gains along the way.
But here's the pro tip, and this is important. It's not an either-or choice. For a lot of people, the smartest approach is to use both. You can use a Roth IRA as your dedicated tax-free retirement engine for the long haul, and at the same time, you can use a brokerage account for more short-term goals, like saving for a house or a new car. They're just different tools for different jobs.
So there you have it. We've covered the whole landscape, from the big picture philosophy of your journey all the way down to the vehicle you'll drive. You now have the map and you have the toolkit. So the only question left is, where will you decide to begin?